Smart investment tips for beginners. Investing is one of the most effective ways to build wealth and secure your financial future. However, for beginners, the world of investing can seem confusing and risky. With the right knowledge and strategy, anyone can start investing wisely and grow their money over time. Smart investing is not about getting rich quickly, it is about making consistent and informed decisions. 1. Understand your financial goals. Before you start investing, it is important to know why you are investing. Some people invest to save for retirement, buy a house, start a business, or build long-term wealth. Your financial goals will determine your investment strategy, time horizon, and risk tolerance. For example, long-term goals allow you to take more risks because you have time to recover from market fluctuations. 2. Start with a budget. Investing should always begin with proper financial planning. Make sure you track your income and expenses so you know how much money you can invest regularly. A good rule is to invest only the money you can afford to leave untouched for a long time. It is also wise to build an emergency fund before investing. This fund should cover at least 3 to 6 months of living expenses. 3. Learn the basics of investing. Before putting money into the market, take time to learn the fundamentals. Understand common investment options such as stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate. Each investment type has its own level of risk and potential return. 4. Start small and invest regularly. Many beginners believe they need a large amount of money to start investing. In reality, you can start with small amounts. The key is consistency. Investing a small amount every month helps you benefit from compound growth, where your earnings generate more earnings over time. 5. Diversify your investments. One of the most important investment principles is diversification. This means spreading your money across different types of assets instead of putting everything into one investment. Diversification reduces risk because if one investment performs poorly, others may perform better and balance your portfolio. 6. Avoid emotional decisions. Financial markets go up and down. Beginners often panic when prices fall and sell their investments too quickly. Successful investors remain calm and focus on long-term strategies rather than short-term market movements. Patience and discipline are essential qualities for investing success. 7. Research before investing. Never invest in something just because others are doing it or because it seems popular. Always research the company, asset, or market before investing. Look at factors such as company performance, industry trends, financial stability, long-term potential. Knowledge reduces risk and improves decision-making. 8. Think long-term. The biggest advantage beginners have is time. Long-term investing allows your money to grow steadily and benefit from compound interest. Historically, long-term investors tend to earn better returns than those trying to make quick profits. 9. Minimize fees and costs. Some investments involve fees such as brokerage fees, management fees, or transaction costs. These expenses can reduce your profits over time. Beginners should look for low-cost investment options whenever possible. 10. Keep learning. The financial world is always changing. Smart investors continuously educate themselves by reading books, following financial news, and learning from experienced investors. Improving your financial knowledge will help you make better investment decisions. Conclusion. Smart investing is not about luck, it is about knowledge, patience, and discipline. Beginners should start with clear goals, invest regularly, diversify their portfolio, and focus on long-term growth. By following these simple yet powerful principles, anyone can begin their journey toward financial independence and a secure future. With the right mindset and strategy, even small investments today can grow into significant wealth tomorrow.